Over the past week, major central banks, the Federal Reserve, the Bank of Japan, and the ECB, have maintained a cautious holding pattern. With developed markets effectively frozen, macroeconomic scrutiny has turned to emerging markets. The driver behind this shift is the energy shock in the Middle East, specifically the Hormuz blockade and the resulting spike in crude oil prices. The concept of a unified emerging market asset class is mathematically dead in 2026. This chart shows how a single exogenous energy shock is fracturing these economies into two trajectories based on their relationship to commodities. Treating these nations as a single block during an energy crisis leads to significant capital misallocation. The March 26th monetary policy announcements provide a specific study of this divergence. The South African Reserve Bank, or SARB, is expected to hold its baseline interest rate at 6.75%. Banco de Mexico, or Banxico, is also projected to hold its policy rate, currently at 7.00%. CPI is a metric that measures the average change over time in the prices paid by urban consumers for a market basket of goods and services. The central bank modeled a negative scenario involving a weaker currency and rising oil prices, assuming inflation would peak at 4%, the top of their mandated 2 to 4% target range. The Hormuz blockade has actualized this negative scenario, with current data threatening to push inflation beyond that 4% ceiling. SARB now faces acute stagflation. This is an economic condition characterized by stagnant domestic growth occurring simultaneously with rising imported inflation. If South Africa signals stagflationary concerns, it serves as a warning for other oil-dependent emerging economies, particularly in Asia. SARB is holding rates out of necessity, attempting to anchor a plunging currency against an external shock they cannot control. Mexico possesses a different structural profile. It is the world's 11th largest oil producer. Looking back at our dashboard, this overlay tracks the Mexican Peso. It weakened by 3.08% against the dollar. This decline is less than half that of the rand, demonstrating the peso's insulation from the crude oil shock. Banxico's inflation data is also distinct. In February, their CPI printed at 4.02. South Africa is managing an energy crisis. Mexico is managing trade negotiations. This divergence creates specific operational requirements for global portfolios and supply chains. Institutional investors are bifurcating emerging market allocations. Capital is rotating out of energy-dependent Asian and African importers facing forced rate hikes. Instead, funds are flowing toward Latin American commodity exporters like Mexico and Brazil, offering oil insulation and high real interest rates. For North American CFOs, Mexico remains a primary nearshoring destination for those decoupling from Chinese manufacturing. However, the July USMCA review introduces headline risk that threatens the projected savings of these nearshoring operations. Treasurers must utilize financial instruments like rolling forward contracts or currency options to manage sudden peso volatility leading into the summer. If these currency swings are not managed, they can erase the labor and logistics cost savings sought through moving operations to Mexico. A final strategy involves accounting for the domestic crises compounding the oil shock in South Africa. Structural constraints in domestic power generation, specifically the energy grid vulnerabilities managed by Eskom, function as an internal tax on growth. Logistics and port infrastructure managed by Transnet also create bottlenecks that limit economic activity. These factors mean that even if oil prices stabilize, South African equities and the rand will continue to carry a high-risk premium. Corporate operations in the region must secure independent power and supply chain redundancies, rather than relying on state infrastructure. South Africa's structural vulnerability stands in contrast to Mexico's localized insulation. Navigating this environment requires moving past a monolithic view of emerging markets towards surgical risk management.